Hello all. So where we left off in chapter 2, we had just finished talking about installment calculations and the requirements for individuals, tax deadlines, payment deadlines. In this video, we're going to talk about similar rules and how they relate to corporations. Now, corporations are not too different, but there are some key differences to pay attention to. So we mentioned that the filing deadline for individuals is generally April 30th, unless they have a business, in which case they have until June 15th. So from December 30th to June 15th is about 6 months for filing time. It's expected that businesses have a lot more records and receipts, and so it takes more time to compile this information. However, businesses are expected to roughly know how much money they're making. And that's why payment due dates are often still before. A sole proprietorship's due June 15th, but the payment's still due April 30th. For corporations, they have to file a T2. Individuals file a T1. The T2 filing deadline in general is 6 months after the taxation year end. Now, individuals almost always file on a calendar base, January, December 31st, but corporations can pick any year end during the year that they choose. So if they choose a year end of March 31st, they have 6 months after that to file the return, September 30th. So wherever they choose to have their year end, they have 6 months to make their tax filings. So, filing alternatives, prescribed corporations must file returns electronically. If you have gross revenues over $1 million, you must file your corporate return electronically. But in this day and age, filing a paper return for corporations kind of difficult, or at least a time-consuming task. So almost all corporations file their returns electronically, even if they don't exceed the $1 million amount. So, insurance companies, non-resident corporations that report their income using a functional currency, or corporations exempt from Part 1 tax. These are items or types of corporations that don't have to file electronically. So, if they're a non-resident corporation, if they're a corporation that operates in another country, they might still paper file. But I'm going to let you know most of these companies file electronically anyway. It's easier to compile the return. It's much quicker to have the CRA assess it. So even though they're not required to file electronically, they often still do. For taxation years beginning in 2024, the $1 million gross revenue tax test will no longer apply because after 2024, they want all corporations to just file electronically. Corporate tax returns are much more complicated, or at least much bigger than individual tax returns because of just the sheer volume of receipts and expenses to go through. So they are pushing that all companies file electronically. They had this requirement of $1 million, but in this day and age of the internet and tax software, almost everyone files electronically. So let's say a corporation needs to pay installments. The installment alternatives are almost identical to the individual, except corporations pay monthly instead of quarterly. So current year will have 12 installments. So if we take our estimate of $12,000, divide it by 12 months, we will pay $1,000 every month. First preceding year takes last year's balance, let's say $24,000. Divided by 12, that's 2,000 a month. So they will make 1/12 tax payable for immediately preceding year. So every month they'll pay that $2,000. Second and first preceding year, that we'll use the second preceding year 2 years ago for the first two installments. So they have 2 months. After the 2 months, they need to update to last year's preceding year, right? So this timing is because you might not know what last year's taxes are. So we'll use 2 years ago for the first 2 months. Whatever that payment is, we'll subtract from the preceding year's balance, and the remaining 10 months will make up the difference. So let's say a publicly listed corporation has 2023 taxes payable of 96,000. 2024 of 126,000, and 2025 is estimated to be 153. So we have our tax payable keeps going up. So when we base it on our current year estimate, we take 153,000 divided by 12, 12,750 per month. If we do the preceding year, 126, that's divided by 12 is 10,500 a month. If we do the 96,000, we have $96,000 divided by 12. That's going to be $8,000 for the first 2 months. So we have $8,000 for 2 months. So that's 16,000 total. We've paid 8,000 twice. So our prior year, 126 minus the 16,000 already paid is going to be $110,000. Divide that by the remaining 10 months and we will pay $11,000. So when we pay $11,000 times 10 plus $16,000 for the 2 months at 8,000, our total amount paid equals the preceding year. So our total payment for our one alternative is 126,000. Our total payments for our second and preceding year is still 126,000, but the installments for the current year estimate is 153. So if we wanted to pick the method that gave us the smallest amount of total installment payments, we would probably take the second one, 10,500. It's the simplest, but because of the timing of having to file and pay the preceding year's taxes, we could potentially rely on that second preceding year for those first 2 months. Now there's a detail here. The example specifies public companies because there's also a type of company called a small CCPC. CCPC stands for Canadian Controlled Private Corporation. So a CCPC cannot be public, and the shareholders must be majority Canadian residents. Non-residents can own shares, but they can't own so much that they control the corporation. Small CCPCs often have taxable income below $500,000. This is a threshold for what's called the small business deduction. So as long as the taxable income's below 500,000, this corporation's considered a small business, hence small CCPC. If their income stays low, but they've been a CCPC for a long time, they might have accrued a large amount of taxable capital. So there's a second measurement that the taxable capital does not exceed $10 million for the current or previous year. So we might have a CCPC that's not making too much money in a year, but their overall value of their assets might still be over $10 million. So although their income is low, the value of the company is still high. So this would also make them lose their small business status. They get a small business deduction deducted in current year. This is what allows them to pay the lower tax rate. So the general tax rate for corporations is about 26.5%. But if they're a small business, there's a deduction to the tax rate so that in Ontario, they'll only pay about, say, 12%. So they have a preferred tax rate. They also need to have a perfect compliance record for GST, HST, source deductions, income tax, meaning they're small, but they're paying their balances on time. If you are maintaining these balances, if you're maintaining your compliance, then CCPCs get certain benefits. One of the benefits CCPCs get is they're not required to do the 12 monthly installments. They're a small business. They can maintain the quarterly schedule that an individual does. Now, the only difference between them, we still have estimate for current year divided by 4 or previous year tax payable divided by 4, but alternative 3, whereas for individuals, the first 2 payments are the second preceding year. For public corporations, first 2 payments are second preceding year, but for CCPCs, only the first quarterly payment is based on the second previous year. Now, why do they allow 2 for monthly, but only 1 for quarterly? And it has to do with this. Any corporation that's not a CCPC has to pay their taxes within 2 months from their year end. So we mentioned that March 31st was our year end. So our tax return's not due for filing until September, but we have to pay our balance within 2 months. So we have to pay our balance by the end of May. So 2 months have passed, and you should have an idea of what your taxes owing is amount. So for those 2 months, you can use your second preceding year. But after 2 months, you have an idea of what last year's payable is. So after that, you have your payment. CCPCs get to have an extra month for their payment date. So tax balance's due date is 3 months after tax year end. Our year ends March 31st. That tax balance is due June. So 3 months is 1 quarter. So we're allowed to use second preceding year for our first payment. But after 3 months, we should have an idea of what the previous tax year's payable was. So 2, 3, and 4 will be based on prior year's payable. So we have this. So that's the confusing part about corporations is first two for monthly, only the first payment for quarterly. Now, if corporations don't file on time or um, don't file on time or have interest, the generally is the same for general. Sorry, let me just start over. Generally, interest and penalties are the same for individuals, except corporations pay just the regular base prescribed rate. They don't pay the base rate plus 2%. So corporations owe at the base rate. Late filing penalties for large corporations are based on their total taxable capital. So if we don't file our return in time, we will pay 0.0005% per month on the corporation's taxable capital for a maximum period of 40 months. So if shareholders' equity is 19.46 million, after 40 months, if they haven't filed their tax return, that penalty of 0.005% would come out to $3.892 million. Okay. Now to focus on the corporate calculations, Madco is not a small CCPC. So Madco is not going to have that preferential quarterly treatment. It has a December 31st tax year end. For 2023, tax payable was 32,000. For 2024, tax payable was 59,000. And for 2025, its estimated tax payable is 74,000. What is the minimum installments for 2025 and when would they be due? How would our answer change if Madco is a small CCPC? So we're going to do this calculation twice. They tell us the tax payable for the various years, and so we're going to do our criteria. The thing about corporations is they're still held to that same threshold of $3,000. Despite the fact that corporations are often much bigger and might have a lot more income to generate, they're still held to that $3,000. So corporations very often have to pay installments, or at least profitable ones do. So for 2023 and 2024, our taxes payable were well over $3,000. So our first criteria is yes. And we expect this year's tax payable to be even higher. So our current year is also yes for over 3,000. So tax installments are going to be required. If it's not a CCPC, let me just zoom in slightly so we're not having too much of the CCPC calculation distracting us. If it's not a CCPC, our first two qualifiers, the current estimate and the preceding year, we just take the balances and divide by 12. So, second, let me just bring this back in. So the preceding year is $59,000 divided by 12. That's 4,916.67, or we'll just round it off to 49.17 per month. So we pay that for 12 months. The total amount we will have paid is $59,000, equaling the preceding year. If we use our current estimate, we expect we're going to pay 74 divided by 12. Every month we'll pay 6,167 due to rounding, but for the year our total payments will add up to 74,000. So that's pretty straightforward. We're just dividing by 12 in order to make our payments monthly instead of by 4 for quarterly payments. Now the second and first preceding year, 32,000 divided by 12. is 2667. So we'll make that payment twice. So combined, we will have already paid 5,333. Now preceding year, 59,000 minus 5,333 already paid, which means we still need to make up the remaining 53,667. So we need to get our total installments to equal last year's balance. We've already paid 5,333, so we're going to need to make another payment of 53,667, and this payment will be spread over the remaining 10 months. So 5,367 for 10 months will make up the difference. So our total installments will be 59,000. For this alternative, total installments is 59,000, but our current estimate is 74,000. So our current estimate is higher. So we probably don't want to base our installment on that alternative. We'll take either preceding year or second and first preceding year, and that's the installments we would choose. How would this change for a CCPC? The calculations are still very similar. We're just using March 31st. So for the individual, installments were due on the 15th, but for corporations, it can be the end of the month. So as long as these installments are made before the end of January, February, March, etc., we're still on side. For CCPCs, March 31st, June 30th, December 30th. So as long as we get it before month end, we're on side. 59,000 divided by 4 is 14,750. So we'll have 4 quarterly payments at that amount. So that's our calculation. If we're a public company or any company that's not a CCPC, divided by 12, CCPCs divide by 4. It just allows us to convert monthly payments to quarterly. If we take the current year estimate, 74,000, divide that by 4, 18,500. Pretty straightforward, right? Easily calculated. So those total payments will be 74,000. So just looking at these two alternatives, we would likely opt for the preceding year, right? Our total installments are lower. The second and first preceding year for CCPC, this is where the calculation is slightly different than our other types. For individuals, the first 2 payments will be based on the second preceding year. For corporations, the first 2 payments are based on the second preceding year. For CCPCs, only the first payment. So 2 years ago, it was 32,000. 32,000 divided by 4 is $8,000. So we'll make our first payment of $8,000. So for the rest of our quarters, we need to get to 59. We've already paid 8, so 51,000 is what we still need to make. 51,000 divided by our 3 remaining payments, $17,000. So we will make those 3 payments through the year if we were to select this alternative for installments. So we might want that installment so that our first payment is low, $8,000, while we're still trying to get our taxes together. And then after that, we'll pay the higher rate of $17,000. So with our 3 alternatives, we would likely choose either our preceding year or second and first preceding year so that we're only going to that $59,000 total. For exercise 2-8, FADCO is not a small CCPC, so it's a public company, or it's a private company that's not Canadian controlled. It has a November 30th tax year end. For the taxation year ending November 30th, 2023, the taxes payable was a 102. For 2024, taxes payable was 54,000. For 2025, estimated tax payable is $17,000. So our taxes owing is going down. What would be the minimum installments for 2025, and when would the installment payments be due? How would our answer change if FADCO Inc. was a small CCPC? So we can see that our taxes payable are going down. So just by looking at our current year estimate of $17,000, it's clearly going to be our preferred installment rate. We'll take that 17,000. 17,000. Now this is not a CCPC, so we'll divide it by the 12 months. We'll pay about $1,400 a month in order to meet that requirement. which is much better than $54,000 divided by 12, which is $4,500. So paying just under 1,500, much better than paying 4,500. So just by looking at the numbers, you can usually get an idea of which alternative you'll go for. But if we wanted to actually calculate it out, here it is again. 102, 54, 17. But always remember that if you choose to use your current year estimate and your estimate's too low, you might be subjecting yourself to interest on those underpaid installments. But assuming 17,000 is correct, do we owe installments? Yes. All of our numbers are over $3,000. Our criteria is both yes. We need to calculate those installments. So we already took a look at the preceding year and current estimate. We know that basing it off the 17,000 results in a much lower monthly payment. If we look at the second and first preceding year, 54,000 divided by 12. Oh, sorry, 2 years ago, 102,000 divided by 12 is $8,500. So we're using this second preceding year for the first two payments. Now these combine to make $17,000. We've already paid 17. So when we update for the remaining 10 months, 54,000 minus 17 leaves 37,000 left. $3,700 for the remaining 10 months. Now these add up to 54,000. Notice that for second and first preceding year, our first two payments satisfies our estimate of 17,000. So we probably wouldn't choose this alternative because we're paying substantially more, 37,000 more, than if we just use the current year estimate. So if 17,000 is what we're going to owe, this is the alternative we would take. And it's due. Our year end is November, so our first payment would be December, the next month, then January, then February, our final payment being in November just before our year end. So the actual month we pay on gets modified slightly if we move the year end of our corporation. If it was a CCPC, we take the 54,000 divided by 4. We take our current estimate of 17,000 divided by 4. That current estimate looks substantially lower than our preceding year. That's likely the alternative we'd take. Applying second and first preceding year, $102,000 divided by 4 is 25,500. We'll use that for our first payment. We want to get to 54,000, our preceding year balance, minus what we've already paid. The other three payments will be made up of the difference. So we have to get to 54. We've already paid 25,500. We need to get to 28,500. Divide that by our three remaining payments, 9,500. So again, these two alternatives take us to the same number, our preceding year total. So we'll likely choose the alternative that gives us the lowest total installments owed. So we'll likely choose this one. Okay. Now that we've talked about corporations, we're not going to address trust in this class or this course. They do follow similar number of rules. 90 days after year end is the filing and balance due date. That's about 3 months. So it follows similar rule to the CCPC, but we're not going to get into that. So this next handful of slides, you can just skip. And when we come back, we will talk about income tax information returns. Thank you for your time. See you in the next video.